Investors' focus continued to be on the evolution of the 10-year US Treasury. After the 10-year rate occasionally exceeded 5% in October, we have seen buyers return to the market, and now the rate has returned to the 460 area, supported by weaker than expected jobs data and unit labor costs. In our opinion, the steep rise accumulated since the month of August had placed the 10-year rate on an overreaction zone. The current quarterly GDP growth rate of nearly 5%, along with the core CPI inflation on the 4% handle, could potentially justify the high levels of nominal yields. However, we expect growth to moderate its pace toward 1% to 1.5%, and inflation to continue to gradually moderate towards the Fed's objective. Thus, the fair value of the 10-year rates would be well below the current one. The November Fed's meeting has been a catalyst to accelerate Treasury purchases. The Fed continued to pause, and Powell messages had a moderate tone, even pointing out pretty significant progress has been made in bringing down inflation and that wage inflation has come down significantly. From an asset allocation perspective in SAM, we continue to see fixed income as our preferred asset class. Tactically, we have made some adjustments, and given the levels reached by yields, we have increased exposure in governments, maintaining our preference in the Eurozone. In credit, our overweight continues to reflect the attractiveness of carry, the stability of spreads, and the lower fear of recession. That said, we have trimmed down our high-yield exposure as the most cyclical component of the credit spectrum. In equities, we maintain a neutral tactical position with a cautious bias.